Hi everyone, I'm Paul and welcome to my review of ICT's 2022 Mentorship Program Lesson 2. The first video was very much just about setting expectations for the program and what you can expect to get out of it as a student, and I shared some of my thoughts about how I'm going to approach the program. This second video really gets into the heart of the trade setup that ICT is going to teach. There's a lot of information in this video, so don't be surprised if you need to listen to it more than once. I myself went through all of ICT's lessons and then came back and listened to many of the lessons again. What I've done is broken the trade setup down into as many clear steps as I could, so you can easily go back at any time and watch those segments again. So my recommendation would be just first time watch the video all the way through, try and take in as much as you can, and then maybe work through some examples in your own time and then re-watch those sections as you need. So as I said, there's a lot to get into, so let's jump right in. So welcome again to ICT's 2022 Mentorship Program, my review of Lesson 2. So as before, we'll just start with a quick outline of the video, and each of these chapters will be outlined in the video description if you want to come back and look at them later. So first of all, we'll just start up with the trade setup that ICT is going to teach throughout the Mentorship Program, and then we'll jump right into the trade setup that he used in that lesson. So starting with a top-down chart analysis, we start with the weekly chart to determine our bias in terms of where we think the market is going to go. The daily chart is the one we look at next to locate liquidity and balances, and then try to find where on that chart we think price is going to go based on our weekly bias. Then we go down to the hourly chart to observe price seeking those liquidity or those imbalance points on the chart. Then we use the 15-minute chart to zoom in and look for stop hunts. And then we use the 1 to 5 minute chart, so you can use any charts in that range, so 1 minute, 2 minute, 3 minute, 4 minute, 5 minute, to find trade entry, exit, and to then obviously manage the trade whilst we're in it. So first of all, we'll just start with the exact trade that we're looking for. So you can see in the orange box I've outlined the trade. This is a screenshot of the screen that ICT shared in his video, and there's a number of trades that he took on this particular day, but it's the last one that we're looking at that's of interest. So you can see he gets set short there at 14,798.25. That's where he opens the trade short, and then he closes out at 14,675.75. And so this is the trade setup that we're going to be studying in the mentorship program. We'll go into more detail about the specifics of that, but it's basically the fair value gap, how to get in, and then where to obviously get out. The trade setup from ICT's second lessons on the E-mini NASDAQ from the 21st of January. It's a fair value gap entry short, and it's about 120 handle trade. So at about $20 per handle, that's a $2,400 profit on that particular trade, and that would have a very high risk return based on the way that the actual setup is created, which we'll go through in more detail. So ICT is going to teach the logic and the setup behind this trade in the mentorship program. It's the only setup that he is going to teach. And whilst in later lessons there are some elements like order blocks and breakers that he does talk about, this is the only setup that's going to be taught in the program. So the goal of the mentorship program is to enable our students to find these setups independently without anything other than the chart. So there's no indicators, a price chart, and to take a trade a week, and hopefully be able to take 20% out of the market, not get caught up in any over trading or the need to trade every session. So that's the overall objective of the program, and we went over that much more in the first lesson. So getting into the trade setup now, we'll start with our top-down analysis. And so our top-down analysis starts with the weekly chart to determine our bias. So it's preferable to do this analysis at the end of the week or at the beginning of the new week. So this is just so you have enough time and you can kind of be detached from the actual sessions of the market. Now, I'm trading crypto, so it's a 7-day-a-week, 24-hour market. It's not as easy to do this, but certainly the weekends for crypto are much quieter. So the objective of this process is to predict which direction we think the market will go for the week. Where do we think price will be drawn to? The size and the range of the next candle isn't really that important. Where the candle closes isn't really that important. All we're really looking to do is to try and figure out what the direction of the market will be for the next week. So the factors to consider in this analysis is obviously the macro factors, so what's going on in a broader sense, seasonality, if there's any particular seasonality factors, at that particular time of year that should be considered. what the momentum's been like in the market, what the correction in the previous candles has been, and how big of those candles have been. And this is all going to be used to assist us with our prediction. So this is the weekly chart that ICT was using in his lesson on the mentorship program. So you can see this is obviously a replay. You can see what the preceding 3 weeks have been like. We've had a lot of downward momentum. This candle was your typical spinning top type of formation, and this candle's broken through that. Generally when you have a break through the low of a spinning top, you get a continuation downward. So from a momentum perspective, you'd be thinking that we were likely to get some more follow through after so much down movement. You're unlikely to get a reversal of a down movement after such a big expansion candle like this one. Also the macro at the time, all the Fed stuff was all very heavy at that period, and so everything was pointing towards the market continuing to trend downwards. So ICT talks about in that particular lesson is that in the lead up to this period, he was always expecting a revisit of these October lows, and the price would draw down to that. Now, in terms of how far price will move and where it might finish is something that only really comes with experience. And so really all we're trying to look at from this part of the trade setup process is just the direction. It doesn't matter how far in that direction it goes, how expansive that candle might be, or how quickly it might get there. It's just really the direction. That's purely what we're focusing on in this particular step. And so from these factors going into the trade setup, our bias for the next week is bearish. So this takes us to our next step in our top-down analysis, and that's using the daily chart to locate liquidity and imbalances. So the majority of our analysis is always going to be on the daily time frame, and this is because longer time frame traders, that might be looking at the monthly and the weekly, will still use the daily, and short-term time traders, who might be using 1, 2, 3, 15, 30-minute charts, will still use the daily time frame. So generally a time frame that all traders are looking at some point in their analysis. And so what we're looking for is for swing highs and swing lows, and this is where the liquidity or stops will be residing in the market. Because remember, above the highs there's going to be buy stops, that's where the sell side liquidity will be, and below the lows that's where the sell stops will going to be, that's where the buy side liquidity is. And if you think about it, logically at the high, that's where traders will be going short, and so to protect their positions or to close out their positions if they move against them, they'll have buy stops which are generally going to be executed at market to close out their positions. And the opposite is also true at the lows. So at the lows, that's where most traders will be going long, because they'll be longing at resistance with their stops underneath, and because they're long, they'll have to sell to close, and again those stops will generally be at market, and that closes out there or flattens their position. On the daily chart, we're also looking for imbalances, and so this is where a candle has either moved up or down in one powerful movement without any price discovery. And so when I talk about price discovery, it's just there's no overlap with the candle, so you don't have the bodies or the wicks overlapping that particular candle, so none of the candles above or below are overlapping that candle. That is basically what a fair value gap is. So we actually use a fair value gap in the setup in the course, but fair value gaps actually appear, or imbalances appear, throughout the charts, during expansions upwards, especially if there's been consecutive up candles, and so they can be on the charts everywhere. And so we'll also, price will be looking or seeking those as well as stops. And so on the daily chart, that's primarily what we're really trying to do. We know that price will draw to either buy side liquidity at the lows or sell side liquidity at the highs, or imbalances on the chart. So what we're looking to do is to apply our weekly bias to the daily chart. So moving on to our daily chart now, so we've zoomed in from the weekly to the daily. And so we're applying here our bearish bias to the daily chart. So from the weekly chart, we anticipate that the market will move lower. We don't know exactly where it's going to go or how low, but we anticipate that it's going to move lower. So now when we look at the daily chart, we're now looking for swing lows or highs. So in this case, we're bearish, so we're going to be looking for swing lows, because we know that's where liquidity is going to be sitting, and we know that price is going to be drawn towards that point. So if we look at our chart now, and remember when I was talking about the weekly bias, ICT had mentioned in that particular lesson that he had been expecting price to revisit those October lows. And so if we go back and look at October, you can see we've got a swing low here and there's a low here. So what we're going to do is we're going to mark up that particular low, and this is going to act as where we think price will be drawn to in terms of the trading as we sort of go into the new week. This is where we think price is going to draw to based on our weekly bias, which is bearish, and on the daily chart where the liquidity will be resting underneath this swing low on the daily chart from October. So now we move on to our next step in our top-down analysis, which is using the hourly chart to observe price seeking liquidity or imbalances. So as per the daily chart, on the hourly chart, we're still looking for short-term lows. That's where sell stops will be. And we're still looking for short-term highs. This is where buy stops will be, because we know this is where the liquidity is going to be residing. So note that we still will have our analysis from our daily chart, and this is where we anticipate price is going to be drawn to. So in our example, we have that low from October. That's where we're anticipating price to go to. In any other examples you may use, you will have set out either a previous high or low, and that's going to be where you think price is going to go to, and all your analysis from this point will start to work towards that particular part of the chart. So note that at any time a significant move lower is expected, you should anticipate a short-term high being taken out first. This is a buy stop hunt to generate the necessary liquidity for institutional traders to get set for the push lower. And so the opposite's also true. So anytime a significant move higher is expected, you should anticipate a short-term low being taken out first. This is a sell stop hunt to generate the necessary liquidity for institutional traders to get set for a push higher. Don't worry if that sounds a bit confusing. When you see it on the chart, it'll make more sense. Just remember that institutional traders need a lot more liquidity to get set in a position. So this requires them moving the market to where liquidity is present so that they can either go long or short in the kind of size that they need to make it meaningful for them before that move in that particular direction. So as I said, we'll look at it on the chart and it'll make a lot more sense. So this is now zoomed in from our daily time frame to now our hourly time frame. Now I've already marked up the chart, but I'll just step through basically what I've done. So we have basically the beginning of the next week's session. So we have Monday, we have Friday, the start of the session, and the end of the session on Friday. This is obviously all retrospective. And so what we have down here is this yellow, that's that previous swing low from October. So that's where we think price is going to be drawn towards. And then in terms of the setup, we have this sell-off that happened overnight leading into the Friday open. We have this low formed here, and so we just have a line here showing where those lows would be. So remember, below these lows here, we have stops residing, so this is where liquidity is going to be. So remember, traders would be going long here, expecting this to be support, so they would go long here and they would set their stops below the low here. Now the market rallies into the morning, and so again, this is where traders would be going short because we're at a high. They would be setting their stops above this point here. So again, they're going short here, anticipating the market to pull back. So they would have buy stops sitting above this high here. So remember, our bias from the week, and you can see this on the hourly chart, has been bearish. We're going into the end of the week and we're expecting lower prices. So remember, we have our price target, for want of a better word, down here that we've set from our daily. This is where we think price is going to draw to. The market sold off overnight, created this low. Now remember, whenever we're expecting price to move lower, we should expect a price move upwards first. And so that's exactly what happens in this scenario. So we have price comes down, it pushes up, creates this high here, and then it comes back lower again. You can see it attacks the liquidity down here, pushes lower, so this candle spikes down because it's obviously triggering all of these sell stops here. Then the market's driven right back up again, and you can see we have equal highs here on these two candles. So we now have 1, 2, 3, all equal highs. So you can imagine, a significant amount of stops have been set above this level, because this is now seen as resistance to most traders. So they will be continuously looking to get set here to go short and be setting their stops, which are buy stops, and the market then drives up past this again. So remember, we've got buy stops being triggered, which pushes the market above this point, and this is the place where those institutional traders are getting set before they drive the market lower. So this is the point that I was referencing in the slide. So anytime we're expecting a move in a particular direction, you should expect a move in the opposite direction first. And the purpose of this is to generate enough liquidity for those institutional traders to get set. So you can see they kind of trick the market. There's this sell-off overnight. It sort of consolidates. They drive it up, creating this high, and then they drive it right down. They take out these sell stops, which then allows them to drive the market right back up again revisiting this high, allowing more stops to be created at this level, which would be seen as resistance by most retail traders in the market. So this is again where they'd be setting those stops. They drive price up and into that zone, triggering off all of these stops, which creates an enormous amount of, or enormous pool of liquidity for them to then sell into, which allows them to get set for the move that they're really trying to achieve. This one down here, which was outlined in our daily analysis. Continuing on in our top-down analysis, we use the 15-minute chart to zoom in and look for stop hunts. So the 15-minute chart, it's just really showing us a much more granular view of what we're seeing on the hourly chart, which is price attacking those pools of liquidity, in each direction before that final move down towards that price target, which we set on the daily time frame. And so as we just went through on the hourly chart, we know that price will seek liquidity in the opposite direction of our anticipated price move. And so it's at that breach of that, a significant breach of that particular high or low that we're really focusing on. And this is where the liquidity is attacked. So this is our area of interest, if you like, and this is where the trade setup, that fair value gap that we're looking for, will be found. So the 15-minute chart really shows what we're talking about on the hourly chart, but just in a lot more detail. So you can see, just in terms of orientating ourselves again on our chart, we have this low here from October from our daily chart analysis, which is still where we're expecting price to be drawn towards, because we have our weekly bearish bias. Then from the hourly chart, we have this high, this low I should say, and this high marked, and this is where we know that stops are residing and where liquidity will be residing, that institutional traders will be attacking in order to get set. So you can see we have that sell-off overnight, that low's formed. So again, you can see that low, it wasn't just one touch, it's like multiple touches, and that's why traders would start to see that as support. The market sort of consolidates, trends higher, creates this high here. So again, this is where retail traders would start to see this as resistance. The market trends down again, comes up, has another touch, so we now have two equal highs here. Again, traders will now see this as even more confirmation that this is resistance. We'll be looking to get short here, or if they're getting short anywhere else, they will set their stops up here. The market then trends lower, and then it attacks this liquidity down here, this sell side liquidity. So you can see it touches it, it trades through, and then it shoots through as all those market orders start getting triggered, which drives the price down. Then the institutional traders drive it back in the other direction. And obviously you have retail traders here all flipping long because they think it's gotten wrong. They see this big spike downwards. The market, react quite quickly and drive the price back up. So they all rush to get long again. Again, we come up to this level and we touch, not just one more time, but two more times. So we now have 4 touches here. So this confirms even more for retail traders that this is now definitely resistance, which is just creating more and more stops at this level. You can see price comes down again before it's attacked again, and you can see, we drive through really, quite strongly through this, resistance, or what retail traders would see as resistance, attacking these stops, which, triggers all this liquidity, pushes price higher, allows institutional traders to get set, and you can see the subsequent move after that. So it's this area here, I'll just mark this up, it's this area here that we're looking at. So this significant spike high through these previous highs is where that fair value gap is going to be created, and that's where our setup will reside. And it makes sense even looking at it from this 15-minute chart. You can see we've got these two quite equal bars, one driving up and one driving back down again before the market cascades downwards. And so now we move on to the final step in our top-down analysis, using the 1 to 5 minute charts for trade entry, exit and management. So you can use any of those charts for this particular part of the trade setup. So you can use the 1, 2, 3, 4 or 5 minute chart, but just should note that the 5 minute still has quite a lot of room. And so the 1, 2 and 3 tend to work best. So in terms of trading crypto, I found that 3 seems to consistently work quite well. If you're trading, something like Bitcoin, for example, depending on which exchange you use, 3 tends to be the most reliable. Sometimes you need to use 4 or 5 if it's a bit thin. And the more liquid exchanges, you can go right down to 1. So it's just something you're going to have to play with. The rule of thumb I'd probably work with is for illiquid exchanges or smaller exchanges, you're probably going to have to use 4 or 5 minutes. For some of those smaller coins or less traded coins, you're going to have to use probably that 4 or 5 minute chart as well. For the more liquid exchanges, and if you're trading Bitcoin or Ethereum, you're going to find that those 1, 2 and 3 charts work the best. And ICT's kind of rule is that wherever he finds that setup first is the one that he generally uses. So I tend to find that I'll have to work my way down, and I go all the way to 1 as well. So I'll go 1 to 5, and there'll just be one that just seems to fit the rules better, and that's the one that I'll go for. So again, we're focusing on the area where the new high or low was created and that liquidity was attacked. So in the example that we're using from ICT's lesson is that there's that high that's being attacked after, that consecutive 3 touches of the high, it was breached. So that's where that liquidity is being created for institutional traders to get set for that bigger move to the downside. Once that new high is set, the market must break back below this level, creating a short-term low. So I've just put in brackets there the opposite. So when the new low is set, the market must break back above this level, creating a short-term high. So hopefully that's not too confusing. The market will break below this short-term low, which is called a break in market structure, creating a new short-term lower low, or the market will break above this short-term high, which is called a break in market structure, creating a new short-term higher high. So don't worry if that's a bit confusing, because I'll go through that on the chart again, and it's much clearer once you sort of see it. And again, with a lot of these things, you just have to do a lot of testing yourself on your charts, and you'll just see the setup very clearly. And if it doesn't meet these requirements, the setup just doesn't work as consistently well. So you'll see that in your testing as well. What I found is I'd find fair value gaps, but it wasn't really, meeting the rules of, say, breaking market structure. And so if it wasn't breaking market structure, it then invalidated the setup. So you'll start to see that more as you practice it, and I'll obviously try and highlight that in the charts when we come through them. So this particular move should be powerful, and this is what creates the imbalance in price, and this is our fair value gap. So ICT's trade entry is based on price trading back into the fair value gap before that move lower in this example in terms of what we're looking for. So this imbalance in the market has to be filled at least partially before the market can continue on in the direction that we're hoping for. So the fair value gap is a setup which is based on a 3-candle formation. The first candle is the spike high or spike low, followed by a candle which rapidly expands down or up to break market structure, followed by the third candle which creates the fair value gap and completes this whole pattern. So our stop is always placed at the high or the low of the first candle. You can also place it at the second candle, and this is just up to you, and you should test this in your back testing to sort of see what works best for you. I found with crypto is that because price tends to overshoot a little bit, you definitely want it on that first candle, and depending on if the high or the low that has created that liquidity is a bit closer, sometimes even though you're taking on a greater risk and you're obviously dropping a potential reward, it tends to just work a bit better. It gives you a little bit more room to breathe on the trade. So just see how that goes with your testing. It'd be great if you could share any insights you have with that in the comments as well. And the entry price and the fair value gap is in between the low or high of the first candle and the high or the low of the third candle. So don't get confused, that's just depending on if it's a long or a short entry, and we'll go through that in the chart. So it's basically the body of the second candle is where that fair value gap will reside, and you can enter anywhere in that fair value gap. So you can use either a market order if you just want to do it in real time, or if you just want to use a set and forget type methodology, you can place your limit buy or sell order with your stop into your platform and just let the market trade back into that fair value gap and hit your limit order. So just a personal preference. And in terms of exit, price targets are determined using the liquidity matrix, and we use this liquidity matrix in concert with the sources of liquidity and imbalances in the market. So this is where we're going to use all of those factors to determine where our price targets would be. Now you might look to part trade, so you might take half the trade off the table at one of those price targets, leave some on to run, or you might close all of it out. Again, that just comes down to personal preference and what results you have from your trading and what tends to work best. So as I said, the liquidity matrix is simply the range from the high to low divided in half, and this gives us our premium and discount zone. So the reason why this is important is because institutions always want to buy at a discount and they always want to sell at a premium. Obviously that's what we want to do as well. So whenever we're buying, so if we're going long, we want to be buying in that discount zone and we want to be selling in that premium zone. And if we're going to go short, we want to sell in the premium zone and then buy back in the discount zone. So we use all these sources of liquidity and balances as our take profit levels. And so this is the 3-minute chart. So we've now zoomed in from the 15-minute to the 3-minute. Now, in ICT's lesson, he uses the 2-minute chart. Unfortunately, the data doesn't go back that far now, so I'll have to use the 3-minute, but the trade setup's still there and it's still pretty much exactly the same as it is on the 2-minute. So don't be concerned if it looks a little bit different to what you see in ICT's video. So in terms of what we're looking at, this is the moves that we had. So we had these lows here formed after that sell-off overnight. We have this consolidation period which sets the highs. Then we have this touch here before the sell lower. So this is the one that attacks these stops, tricking all the retail traders to go the other way, drive the price back up, and then attack all this liquidity sitting up here. So all these buy side stops up here. So you can see we had 1, 2, almost 3, 4, 5, 6, 7. So quite a lot of touches. So there's a lot of opportunity there for traders to be getting set to the short side. Looking at this as short-term resistance and putting their stops there, which is exactly what the institutional traders are looking for, seeking out that liquidity to get set. So you can see we have this push higher, followed by this down move. So you can see this down move here, this candle here, we have this low here, and this is where our fair value gap gets created. So the first candle in the move is this one higher. So you can see, I'll just zoom in to make it easier to see. So this is the big up move we're talking about. We have a new low formed here. The market pushes back up again, and so this is candle 1 in the setup. Then we get this big powerful move downwards. So this is that explosive move we're looking for which breaks market structure. So when we talk about breaking market structure, we're talking about breaking the low of that candle. So you can see we pushed higher, created a new low, pushed higher again, and then this candle very forcefully drives the market downwards. It breaks this previous low, and then we have, so this is the second candle in the setup, then we have this third candle, and we now have a lower low being set up. So this is our break in market structure occurring right here, and this is where the fair value gap gets created. So the fair value gap, remember, it's an imbalance, and so we're looking at this section here. And so basically what it is, we've got a 1, 2, 3 candle formation. So this is the first candle. The second candle is the one that breaks market structure and should be a powerful move. And then the third candle is basically what helps consolidate this move and create, the lower low, which is this break in market structure. So the fair value gap is created between, in this case, the low of the first candle and then the high of the third candle. So the fair value gap should encompass a large portion of the body of that second candle. And in terms of how we then enter the trade in this particular setup or any fair value gap setup, is we want to enter somewhere in this fair value gap. I'll just get rid of that there. So anywhere in here, so you can see what happens is the market continues to drop away and then it comes back into this fair value gap, and that was the time to get set. Now there's a couple of ways to manage the entry of this trade. So you could either, and if you watch ICT's videos, often because he's using the 1 minute chart, he'll just be executing a market order, obviously trading in real time. So he will just sit here and wait for the price to come back into this fair value gap and either hit a market order long or short to get into the trade. Now, you don't have to do it this way. The other thing you can do is you could set a limit order. So you could set a limit order, if you wanted to be the most certain, you could set it at the high of that candle. So your limit order would be, sitting here. So it would look kind of like this. That would be your limit order to sell just there. And in terms of where you would place your stop, you would place it at the high of that first candle. So if I just take this box away, it would look like this. So this would be that would be where our sell order would be. Our limit order to sell would be just there. And our stop would be there. And so entry here, stop here. And so you could set that as soon as this formation forms. So as soon as you get the close of this candle, you could put that order into your platform and just wait for it to execute. The other option is you can just sit and wait for it to trade in. It's completely up to you. Obviously, the risk of just using a market order is that you could try to get a little bit too cute. You're trying to always get that, little bit extra, and you may completely miss the trade. So you can see in this scenario, using the 3 minute chart, it only really price only comes back into this zone very briefly before it runs away. In terms of how I've been mostly doing it, depending on when I see the trade, so I've been using fair value gaps in a lot of my trading on a daily chart, so that's obviously a much longer time frame, and so there's more time to sort of finesse the entry, where when you're trading on these short time frames, you don't have a lot of time. So ICT also talks about, if you miss this, there's nothing wrong with, you could get in, around here somewhere. But the problem with this kind of allowance, if you want to call it that, is leaving it too long, because, if you were only attacking, say, a 3-hour return trade, every time you let it run a little bit too much, you're just increasing the amount of risk you have to take on and eating into, your potential target. So just be a little bit conscious of that. You don't want to chase it too much. The way I look at it is if it runs away and I miss it, I just miss it, I don't chase. And so that's why, to some degree, just using the limit order with your stop just preset, and if you get hit, you do, and if you don't, you don't, and then you just walk away. It tends to be just a little bit less stressful. It can be a little bit annoying if a price, drives right into this zone and you could have got a much better fill, but that's trading. Sometimes you're going to get better fills. You prefer to get in the trade than miss it, especially if it ends up being a really good trade. So the rule of thumb that ICT uses is that once you've breached the low of this lower low, then you shouldn't chase it. So you can see you've got a little bit of wiggle room here to get in on the trade. And obviously you can see it starts to accelerate away. The risk is that you chase it, you get in, down here it comes back up, and so you can see that then your risk on the trade is significantly larger. Now in terms of the stop entry, you can finesse this a little bit as well. You can choose to put the stop on the second candle, on the high of the second candle, or on the high of this first candle. What I've noticed with crypto a little bit is it tends to overshoot quite a bit, and so just depending on where these highs are, you might want to give yourself a little bit more room as well. So that just gives the trade a little bit more room to breathe, but you obviously are increasing the risk, which means your trade size has to be adjusted to compensate for that. So just play around with that. Again, that's something that you start to see in testing, and you can make adjustments accordingly. So the one thing ICT talks about with this particular setup, and I experienced it myself with some of the live trading and forward testing that I did, is that it feels quite counterintuitive at the beginning. You've had this run up high, the market then comes back, this fair value gap's created. And especially in crypto where, as I said before, the market tends to overshoot. So that fair value gap will often get completely filled and come right, very close to your stop. And so it feels very counterintuitive to be trying to enter a trade when the market feels like it's going against you. We're so conditioned in terms of normal trading that we're trading at resistance, you want to get confirmation, all of that sort of thing. And so this is a little bit counterintuitive in that regard. So what I found is the more I traded it, the more I tested it, the more I got comfortable with that and just accepted that that was part of the trading mechanics of this particular setup, is that I'm going to be, in this case, selling into the strength as the market comes back into this fair value gap. And you generally tell pretty quickly if you're on the right side of it, the market should reverse relatively quickly, or you get stopped out pretty quickly. And so the good thing is you're either in the trade or you're not. So in terms of managing the exit now, basically there's a couple of things we look at. So we look at where sources of liquidity are based on the chart in terms of our exit points, where imbalances are, and we also use the liquidity matrix. So the liquidity matrix, to start off with, is really straightforward. We just take our fib, we take it from the low, so that's our low down here, all the way to the high, and this creates a discount and a premium zone. So anything above the 50% level on the fib, so you can see up here above this point is the 50% level. I've actually got a setting for that, so let's just change that. So up here is our premium, and below here's our discount. So there's the low, that's the bottom of the range, our high, the top of the range, and here's our 50% level. So you can see here this pink, that's where ICT gets short in his setup. So remember, I'm using the 3 minute, he used the 2 minute in his video, so this is going to look slightly different. The gap, the fair value gap is here, but it's slightly different. It's a bit tighter on that 2 minute chart that he uses, but most of the structures are pretty much the same. So he got set there in terms of his sell. And then what he was looking at is, you can see here, we have this clustering here. So we have this swing low here. So he's expecting, in terms of his exit, that there's going to be liquidity there. And so he's going to use this liquidity. So remember, you would have traders going long here because that would be seen as support, so they would be going long here, they were putting their stops here, so remember they're going long, so they have sell stops. So we're going to be buying to close, and so we would be looking to use that liquidity as part of our exit. Now the other thing that's also here, and again this is going to look a little bit different on ICT's video because he's using the 2 minute, but you can see there's a fair value gap here as well. So as the market rocketed upwards after that stop hunt to the downside, these big candles have created fair value gaps on the way up. And you can see there's actually a couple of them. So there's one here as well, and there's one here, even though this gets filled. And so as the market's coming downwards, these are what you'd call bullish fair value gaps. And the market's bearish, it's going to now hunt these. So it's going to come and fill these in. And you can see that's exactly what the market did. And so this is why ICT then used this level. This is slightly different. I think it's 0.75 that he got out at, but it shows the same thing, is that as the markets come down, he's used then the stops residing here and this liquidity gap here, this imbalance. He's then used the stops residing here and this fair value gap here as his target, as his mechanism to get out. So you know that there's going to be a lot of liquidity here, and you can see the market attacks that before it comes back again, and then it sells off again afterwards. So this ended up being a good place to get out. As you can see, the market continued to fall lower, but just remember that we're looking for the low-hanging fruit in these particular trades. We're not looking at getting greedy. We just really want to get in and get out. We're trading on a 3 minute time frame, so this is not a long time to be sitting in a trade. But you can see this is all, why it's so important to do your own back and forward testing, is just to see how you would then manage the trade. And this is also a personal preference. So for example, in this particular trade, you could have chosen to say, choose to close part of the trade out at this particular point, and leave the rest to run. So knowing that there's a fair value gap residing down here, we still have a bearish bias, so we're expecting the market to go lower. And remember that we have this price target down here from the daily that we think price is going to draw to. And so that's exactly what happens. The market does sort of bounce back a little bit after this, but you see you could have left a little bit more on the table to eke a little bit more profit out of that trade. And that really just comes down to confidence in the setup from back testing and forward testing, and just what your risk tolerance will be. So there you go, there's my review of lesson 2 of ICT's 2022 mentorship program. As I said at the beginning of the video, there's just really a lot of information in that particular lesson, and what I've aimed to do out of my reproduction of that is to break it down into logical blocks. So really use those chapters in the description to go back and revise your learning. I'd really recommend listening to the video just all the way through once, and then maybe going through it a second or third time and write better notes after that, because there just really is so much information to get through. And what I found personally is that I've done this second video now a number of times, even though I've gone through all the other videos. I just keep coming back to this one. It's because I think this is because ICT really goes from end to end in terms of doing that initial analysis right through to trade execution, and that's really helpful. And then some of those later videos goes into much more detail about the particular components of this setup. And so this is sort of, I guess, your umbrella lesson for the rest of the lesson. So I hope you enjoyed my reproduction of that, and I hope that my explanations of that helped with your understanding. I'm really enjoying this series, getting really great feedback. So if you like this video, it'd be great if you could hit that like button. That will help other people to find it. And if you'd like to continue following me through ICT's mentorship program, then subscribe to my channel so you don't miss any videos. And I'll see you in the next video.